All right, so good morning, everybody. We appreciate our chairman. Ezekiel is my name. Chairman has been here giving us profit from 4 a.m. and we've taken 3 rounds already. All right, on Wealth Hub, and we are super excited and we celebrate our chairman. All we can say is God bless you. This is given to us for free. Okay, so today we are supposed to be embark on trading psychology. For all you do, you know, with the anchor point, what holds everything together is actually trading psychology. You analyze the markets, you employ a strategy, you are maintaining a risk management, you know, and your trading plan is there. What holds everything together is trading psychology. So trading psychology is that emotional part of you. That's part that shows that you are very much emotional intelligence. And when we say intelligence, intelligence is learned. You went to school and now we can say, oh, you are super intelligent. You know so much about a specific area of discipline. You're super intelligent in that line. And you can't be on the foreign exchange market, the financial market, and you will not develop some level of intelligence around that. So the core intelligence you have that will help you to sustain success on this market is emotional intelligence, and that is what is captured on trading psychology. So trading psychology is the mindset of a trader, right? Is the mindset of a trader. What kind of mindset do you approach the market with on a daily basis? How do you play around with your trading strategy? How do you play around with a trading plan, your risk management? How do you play around with your, control your emotions? So 4 cardinal points are involved in this, and this is cognitive bias. In all you do, there is those elements of bias, all right, at least some certain part of you, based on your analysis, is tilting towards a certain path. It's inclining towards a certain decision much more than the other. And that's what plays every day, all day, because the market is highly probabilistic, very probabilistic. You must train your mind to be able to manage that probability. So emotional control is another aspect. Risk management is another aspect. Mental discipline is another aspect. So all of these are put together on what we call trading psychology. So understanding your mind is the foundations for successful trading. You must learn to master your mind. So why psychology matters? It matters, one, because of the dominant factor, all right? Trading success is considered to be a matter of both strategy and psychology. And to experienced trader, it has come to a level that we give more, strength to the trading psychology part. Trading is more or less the technical and the fundamental part. And there is also a part of the psychology. Even there is this sentimental part of trading that you must know all of that. Then what is holding everything together, whether you are a technical trader, you are a fundamental trader, or you're a sentiment trader, it is the psychology that holds everything together. And we always give this weight of 90% to psychology and give 10% to strategy. So those are the dominant factors, the psychology and the strategy. Strategy is to the part of the technicality, the fundamental, the sentimental, that belongs to strategy. Then how do you master your mind in the face of this? Because the way you feel, will always reflect on the market. The market mirrors you. It mirrors your personality. So you must really master that part of you and be able to know yourself on the market. All right, decision interference is another aspect. So trading psychology directly affects every decision a trader makes. Emotional pressure leads to impulsive behavior. If you are under any emotions at all, maybe family pressure, or I must point this out to anybody that is on this financial market, you want to start trading and all that, or you started trading, you must be able to eliminate any form of pressure All right, I don't encourage anybody to actually embark on a loan because you want to know how to trade because of how lucrative it is. If you Google the best paying, the highest paying career, trading is topping the charts. Trading is topping the chart, and you see how lucrative it is, and then you put yourself under pressure. It's going to impact so greatly on your psychology. And if that impact on your psychology is not going to make you perform so well, all right. Another thing is strategy override, right? The most sophisticated trading plan can be flawed if the trader is unable to manage their emotions. So if you're unable to manage your emotions, you would, no matter how good you are a very good, you've mastered your technical analysis so well, you're doing so well on that. If you are unable to manage your emotions, you will not be able to be successful. Everything you do, your emotions will override everything. Your best strategy you've planned and how to execute, and you just notice that suddenly you didn't even remember what you planned to do. You're doing what you never planned to do. So that's strategy override. So root cause analysis. All right, psychological factors are often the root cause of poor decision making. You see, for all you know, technical, fundamental, sentimental, the problem why you're not really winning or having a winning hedge is because of your trading psychology. It's not robust enough, or you've not really been paying attention to trading psychology. So understanding and mastering one's own psychology is a critical step towards improving trading performance and achieving long-term consistent profitability. So you must master trading psychology. Don't overlook it. All right, don't overlook it. So the emotional roller coaster of trading is is a function of fear, is a function of greed. So that's how you can classify that emotion. And that emotion is somewhat okay. Let's say there's no element of risk involved. You're not doing anything that has to do with either losing your money or making profit on your money, and you're just on a basic emotion. Basic emotion, maybe you wake up and you want to enjoy the good life, you go to the beach, you see how you feel so relaxed and you're enjoying yourself and all that. That's just basic natural emotions. But when it comes to the market, the emotions that is staring at you is very different. It's more of fear and more of greed. And how do you manage this? So at the point, the fear is coming to you like an hesitation. You see a very perfect setup, but you are scared to execute. You're like, okay, should I go in now? Should I not go in now? You see, of all the trades that Chairman called, we have 709 persons on the group. And how many persons are celebrating those wins? That means there are some persons who are still looking at the market like, should I or should I not? Hesitation. That's an element of fear. You just do that thing. Just do what you have to do. All right. Another one is panic selling. You're already on the market. And then the market, maybe, of course, market will always averages, right? It goes up, it comes down, it hits the floor, it goes to the ceiling, and that will always happen in cyclical moves. At some point, maybe you enter, you just start, you enter a trade, you want to buy gold or sell gold. As at the time you enter, before you know, it's not going your direction immediately. And that way you started getting scared and you quickly close your position and sold and run away, win losses because you are scared, you're fearful. Is an emotional problem. All right, your psychology is not really intact. So that it goes the other way does not mean that it will not come back to profit, except the bias has changed. Another one is premature profit taking. You are in the market, TP1 has not hit, and from all indication, TP1 is still going to hit. Your bias is still very much correct and intact, and you just run out of the market because you're scared of losses. All right. In the first place, before you even enter the market, you must settle down with yourself. How much am I willing to lose? That was the part of the risk management. Like I stated, the four parts: the cognitive, the emotional, the risk, and the discipline. So you must settle with yourself. How much am I willing to lose? If you don't settle down with yourself before you start trading in a day, you won't do well. Your psychology is not balanced for that day. So another aspect is greed, right? Greed, over leveraging. You are over leveraging too much. Every day you enter the market, you just feel like you want to pack all the profits. The market is not meant for you alone. You just have to stick to your plan, stick to your risk management, stick to what you want to do. Don't do what you never planned. Greed, again, ignoring profit targets. All right, you've set out a certain target. At some point, you now feel like, okay, it's going to go further, and you are still on that market. You are shifting your profit position. You think it's just going to be following you as if you own the market. It doesn't always happen that way. Then revenge trade, you lose trade. And somebody called me. I don't know if she's on this call. All right, I feel pity for her. At some point, her trade was not going well, and she kept adjusting her stop loss. You don't do that. That's greed. All right, you kept adjusting her stop loss, and that's not too okay. And on revenge trade, you lose trade. You quickly want to run into that trade and want to recover. It doesn't work that way. So for everyone that has losses yesterday, you see that today is a fresh day and there are a lot of recoveries already. So you don't do revenge trade, running back into trade because you lost $10, $20, you want to quickly make it back. No, your psychology is not right. And anytime your psychology is not right, when you lose two trades, don't go back to that trade. Leave it. All right, go freshen up. Tomorrow is another day, and tomorrow is a winning day. Have that mindset. So the consequences are as follows. Deviating from strategy, you already have your strategy, your trading plans and all that. And before you know, when you start trading, you're now doing a different thing altogether. How many persons are finding themselves guilty right here? You're doing a different thing. You don't even remember what you analyze, what is the reason for your entry. You forget everything and you're just trading reactively. All right, poor risk management. You must make sure your risk management is intact. Settle with yourself how much you want to lose before you even start. And don't be a greedy trader. All right, don't be a greedy trader because you're going to double down on your losing positions because of greed. You've made profit, you should be okay. Don't like you've made profit, you've hit your target, you want to still continue trading. Once you hit your target, you're good for the day. All right, psychological burnout. Emotional roller coaster creates stress. Don't trade from morning till night. No, it's going to cause burnout. Once you hit your target, you're good. Go do something else. If you don't have anything to do, go to the gym, go and exercise yourself. All right. Check out, take your wife out, take your fiance out, and just do something else. Do something else, and don't avoid boredom. Don't feel bored. Leave that trade, close that laptop, and go do something else. So managing trading emotions, first thing is mindfulness. You must strictly be self-aware. All right. You must observe your thoughts, your emotions. You must be 100% self-aware. And don't think that emotion is a bad thing. No, emotions is part of life. That's what makes you human. So it's okay to have emotions. But on this market, you must be able to tame that emotions to be able to align with where you find yourself. All right. So you can do that in every other field of endeavors, in any other market, let's say oil and gas, and every other market you find yourself, allow your emotions to just take a toll on you. But on this market, it must not. It must be tamed. It must really, really be tamed. So practical tips. Before each trading session, spend a few minutes in quiet meditation. It keeps you in check and puts you on the right mood. So focusing on your breath during trading. Sometimes, like this morning, I didn't feel like trading because I was actually working on this psychology of trading, and I didn't bother entering the market because I'll just be juggling between, it's about trading psychology today. I'm on a position. No. If I lose the profit today, does not mean I'm not going to make the profit on Monday. No, it doesn't mean that. So everything I was doing today was just, training myself on trading psychology because it holds everything together. And if you don't get psychology right, you can never get any aspect right. It's not possible. So check in with yourself, acknowledge your feelings, know how you feel. Sometimes you may want to come into the market and you feel scared. Don't bother. Has that happened to you before? If that has happened to you before, just put 111 on the chart. Let me see. I want to really see. Put 111. You want to enter the market and you just feel scared. If that happens to you, forget that market that day. Don't bother. Just do enough of meditations, listens to motivations, do your go to gym, do something else. For that feeling alone, your psychology is not in shape. Don't bother to trade. So the profit you're missing out on that day, no matter how many persons celebrate, should not affect you. That day is you are not in the best frame of mind, so you must not trade. All right. So be very much self-aware. Know how you feel. All right. Anxiety or greed as they arise, and consciously choose to stick to your trading plan. Don't, once there's anxiety, run away. Don't bother. So the trading journaling is the next aspect. You must have trading journals. Some persons have been here for several months, several weeks. Do you have a trading journal? You don't have it. All right. The practical tips there is that you maintain a trading journals. It includes columns of the trade setups you've taken, reasons for entry and exit, and the emotions and thoughts you experienced during the trade. How did you feel during that trade? Why are you taking the trade you're taking? What is your asset pair? All of these things must be on your journal. All right. So to everyone that's, they are superstars in signals, they don't even have a journal. How will you even have a journal that you've not trained yourself enough to know why you're taking the trade you're taking? Trade is being called. Why are you taking that trade? You're taking that trade because it agrees with your analysis. And if it doesn't agree with your analysis, then you've not matured enough to start analyzing the market, then groom yourself to be able to come to that level, because a lot of signals comes day in, day out. Chairman is calling, Joel Arias is calling, Arabella is calling, Lucas is calling. So sometimes it will even contradict. Maybe Arabella calls a buy, Joel is calling a sell. How do you manage that? So you should be able to have a way that you're journaling this, and you should be able to analyze the market and know why you're doing what you're doing. You're not just doing what you feel like doing. So self-reflection, at the end of every day, you must be able to check, okay, what's my what did I achieve today? What are the process that was involved in that? All right. It's more of a process, not of a result. So at the end of each week too, you must do that assessment, reflect on what you have done for the week, go through your journals and check everything you've done, because each thing you do, short pencil is better than long memory. You must go back to check everything you're doing on a daily basis, on a weekly basis. Don't let any day pass by without you checking with yourself what you're doing on each day. So the goal is not to eliminate emotion, but to develop awareness of how they influence decisions and build a mental framework to maintain discipline. All right? The whole goal is you just have to be disciplined in how you do. So trading psychology helps you with that. So cognitive bias in trading. So cognitive bias involve the confirmation bias, anchoring bias, availability bias. You must check all these biases, reasons why you're doing what you're doing. Why are you doing what you're doing? So tendency to search for and favor information that confirm pre-existing belief. You already have a mindset. Sometimes, because of too many information flying around on the community and everywhere, you just read an information and it's stuck with you, even though that information does not apply to the market presently. But because you read that, you held on to that, and that affects your trades either negatively or positively. You must be open, be very, very open. All right, because the market you're dealing with is probabilistic. So if you are just so stereotyped, one-way traffic, some bad things could happen. All right, so be very, very open in the way you approach the market. So based on a pre-existing information or belief, your culture, some persons are just prone to like, okay, they expect, oh, gold is always buying. Yes, that happens. Bitcoin will always go up. Yes, we know. But sometimes your analysis may represent that there will be a slight dip based on analysis. So be open to that. If there is a dip, there's a dip. If there is, if the market is bullish, it's bullish. So just be open. Don't stick to one side and just stick to that alone. So create an anchor chamber, reinforcing desired outcome rather than objective reality. So the next one is anchoring bias. So relying too heavily on the first piece of information received. Someone told you this and you just stick to that. Or traders who bought, for example, gold at 3,410 refuses to sell. Maybe the market drops and they are like, no, it will continue to buy. It will continue to just anchor on that particular initial analysis. Biases change and it's a matter of seconds and minutes. You might be thinking it will actually, be on the uptrend, and before you know, market and the changes direction and is now going towards the downtrend. I love the fact that we pick the buy, we pick the sell today, and I so enjoy that. Yesterday it was more of sell, 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 but today you saw the balance. We went for the buy, we went for the sell. We didn't anchor on today is only going to sell or is only going to buy, and it's just a balance, and I love that so much. Availability bias. You are relying on examples that are only available to you. You don't explore other options. All right. I'm one of those persons. Sorry, I have to say this here. I just want to know everything, because sometimes what you know is not what the market wants to respect today. So what if the market wants to take on some other things you need to be open to? So you just need to be open to them and see how that impacts on the market for that very day. So after witnessing a market crash, for instance, and anytime you see the market is kind of going downward, you feel it's going to be a crash and you rush out of the market, because what is available to you is just that piece of information that whenever you see a certain candle, maybe a very long dip, you feel this market is just going to crash and you run away. And before you know, the market recovers and everyone's still holding on, actually making profit on that market. So key insight there, the biases can work together to reinforce poor trading decision, creating a perfect storm of flawed analysis. So you must be very careful with your bias, holding on to one thing too strongly and not being open to other ideas. So overcoming trading bias. So recognizing and becoming cognitive bias requires effective strategy that challenge your mental shortcuts and improve decision making. So an aspect of that is critical thinking. Challenge your assumption by asking, what evidence support this belief? I've come up to the stage that I create a checklist for myself. I'm analyzing the market. I'm expecting something to happen. And I'm actually creating a checklist. All right. If I see a signal, if I've not done a pre-analysis that support that signals, my lot size there will be very small. And I create a checklist around all those things. Why am I doing what I'm doing? Why am I taking big lot size? All right. Am I too sure? And is he agreeing with this signal I'm taking? Check. This, check. That one, checked. Then I can decide what I want to do. All right. So you must have that kind of checklist to enhance what decision you're taking per time, because all of this is a function of your emotions, the way you feel per time, and what evidence would contradict it. All right. If you expect the market is going to sell, and you should also be on a lookout for, if anything changes, what is the reason it will go the other way around? So check out for all those things and do a critical thinking around those. But that doesn't mean you overthink it. So diverse information sources, seek out and consider multiple perspectives from different analysts. People trade differently. This one is saying this and it has its reasons. This one is saying this and it has its reasons. Be open, but still be yourself in the market, because you will eventually be unique. You just be yourself. You will be yourself on the market. There is no time you won't be yourself. You try to be like some other person, you won't enjoy your ride. All right. So news outlets, get as many information as possible, market experts to avoid one-sided information. Because somebody may be saying this and the other person is saying this, then you'll be able to strike a balance because that gives you, enough options to be able to play around on the market. All right. So sometimes, so you see some things posted. If you're on TradingView, you see a lot of chat. Some person will say, oh, what's it now? Some person will just state that the market is on red. Anybody taking a buy is on obituary. What a strong statement. If you don't look at it from another perspective, you just feel that's how it's going to be. And if it did not go like that, you'll not be blaming yourself. Right? It's your money you have to protect. It's your equity you're protecting. So you must get enough information to be able to take an informed decision. So in market execution, follow your trading plan without deviations. If you have planned it, this is how you want to play today, play that way. No divisions, not in the middle of the market, you're changing tactics. No. And post-market review, after everything you've done for the day, go back to check how far. That one you're not trading. Go back to check how far you've done. And at the end of the week, check how far you have done for the whole of that week. So the practice of self-monitoring is crucial for identifying and correcting emotional mistakes. Because if you're not putting this in check, you keep on making mistakes. So every day, all day, check after the close of business how far you've done for that day. So, and you're not checking what results, how much profit you have made. No, you're checking process. All right, please put on the chat box. Check process, not results. Check process. You do stick to all the processes, check those ones. So managing risk and maintaining discipline. So setting clear goals is very key. And what are those goals? You've told yourself that you're only risking 0.5% or 1% for the day. It's a goal. You must not risk more than that. All right. And if for any reason your 1% is already done with, that's all for the day. All right. Don't go further. Like, okay, let me try. The market is now looking beautiful. Let me reach 2% today. No, don't do that. All right. Trading plans, you must stick to that, your trading plan. Develop and follow a structured trading plan that includes the entry, the exit criteria. Example, price breaks above 20 period moving average after a bullish engulfing candle. You just have to check all of this, all right, before you enter the market. You must have a set out plan. For those that trade SMC, you're looking out for the fair value gap, you're looking out for the best entry. You've already pre-planned this, and then you can now execute, and don't change it along the line. So using stop loss order, don't ever enter a trade without stop loss. If your stop loss is for 10 pips, 10 pips, 20 pips, 20 pips, 30 pips, 30 pips, and stick to that. All right. Daily routine. Establish a consistent pre and post trading routine to maintain discipline. You must establish that before you trade and after you trade. Make sure you do that and follow it. Review your journal daily, identify emotional patterns, and improve decision making. While you review, check your emotional, the way you felt it exactly, write it exactly that way on your journals and make sure you are improving. If you are too emotional in the market, work towards adjusting your emotional patterns. So position sizing, calculate position size based on risk, your risk tolerance, not emotional desires for big wins. Some persons are just want to make big wins. Sometimes the trade might not quickly deliver your target. And if that happens, no problem. Stick to what it has delivered. Chairman will say, don't let your blue turn to a red. So it's not because you desire to make, you're under pressure to make $1,000 and the market is not smiling at you and you're still there waiting that it will come and give you $1,000. Please run a balance. So on your risk management, like we did RST with Antibola the other day. If you're sticking to 0.5, that's how much you're willing to lose for that day. Stick to that. If you're sticking to 1%, that's how much you're willing to lose for that day. Stick to that. And nothing should make you change your mind. All right. No matter how someone is telling you he heard from the prophet that the market will deliver this and that, stick to what you have planned. So avoiding common pitfalls. All right, stay clear of over trading, revenge trading. Run away from it. Right after you made losses, don't bother trading again. If you target 2-to-1 risk to reward ratio, 2-to-1 risk to reward ratio. If you target 3-to-1 risk to reward ratio, stick to that, and that is all you have to do. So discipline is the bridge between goals and accomplishment. You have to be disciplined. So building a trading plan around market and time frame. All right, the specific market and chart time frame you will trade. On your top analysis, you are the type that does monthly, weekly, daily, and then 4 hours, and then you cascade it down. Stick to it. If you are the type that do 4 hours, 1 hour, then cascade it down, stick to it. All right, just stick to your time frame and how you deal with your market. All right, entry criteria, the exact entry you want to do, stick to it. All right, stick to that. Exit criteria, the stop loss, stick to it. Position sizing, stick to it. All right, you calculate your positions, your TP1, your TP2, where you want them to be, stick to it. It's not enough to have a risk, a lot size of a certain amount, and you don't know what lot size should be allotted to each position. You must know that on position sizing. Trade management, rules for managing the trade, stick to it. Your break even, your trailing stop, stick to it. Don't just keep it open and feel like you own the market. No, your risk management must be top notch, very much top notch. So implementation process, in-market execution, follow the trading plan without deviation. I've said that again and again. Then post-market review, check your trading journals. Every day you're done, and every week you're done. Check everything you've done. Developing a resilient trading mindset, self-awareness, and emotional intelligence. This is what this is all about. So your high Q capital, your intelligence quotient capital, based on the strategy, the technical analysis, fundamental analysis, sentimental analysis, all those ones. Yes, you must have emotional intelligence. You must discipline your emotion. You must have a well-disciplined emotions. You're not greedy, you're not fearful, you don't overtrade, all of those things, you must put them in check. All right, be mindful observation, check in with yourself before and during trading session. You must do that. Chinyere, don't do that. All right, keep your hands to yourself, Chinyere. All right, so trading journaling, I mentioned that you must see those things that must be contained on your trading journal. Adherence to your plan, focus on the following, on your strategy, focus on it. All right, making money, evaluate executions. That's on focus on process overcomes. You focus on process, you definitely will have a winning edge. All right, performance review, do that. Probabilistic mindset is very key. You can win, you can lose, and you must make sure your loss is less compared to your winning. Keep that at heart and make sure you run that way every blessed day. Some persons don't know how to stick to this. So make sure you master how your losses can always be reduced to the barest minimum and how your wins can always be very high. So building confidence through experience. There's something I've noticed. When you see stop loss is very high and your lot size is also very big, you are just digging a grave for your equity. If your stop loss is very high, does not mean that your lot size must stay the same. If you've not understand how to do that calculation correctly, then you have to find a way around it, all right? So building confidence through experience, education, you educate yourself, remain a student. Don't ever graduate any day, all right? I learned from chairman, before you know, he said he went back to study. He went back to learn. I'm like, I'm so impressed, like, wow, even chairman is still going back to study. So what am I doing? You have to continue to learn, right? Make sure you have enough experience. Experience will help you to build confidence, all right, through structured progression, all right, and back testing. Do back testing. How do you back test? A strategy you're working on, Go back to check in time. Is it working? Is it not working? Check. That's back testing. And any if you want to was it forward test, use demo trade. You're working on a strategy. Demo trade before you start putting it on your live account. And on your live account, trade small first before you start bringing in big equity on your live account. So you must check in with yourself on all of this, and gradual scaling, increase position size only after achieving consistent execution and success rate is high. That's when you can now start improving your lot size and all that. So don't just start your day and you're starting with 0.1 or start up 0.1, 1, 2, those standard lot size. If it's not your level, it's not your level. All right, chairman might comfortably take, standard lot size, and you want to be like chairman. Not yet. Wait for 10 years. I'm not saying you actually do it 10 years, but wait until you're confident enough. Like we say, building confidence through experience. Wait till you're confident enough before you start taking those risky lot size. All right. A resilient trading mindset is not the one-time achievement, but requires ongoing maintenance. The high stress nature of trading can lead to burnout and emotional fatigue if not managed properly. So be in check at all times. So the last slide right here is maintaining a healthy trading mindset. So self-care, ensure adequate sleep, maintain a healthy diet, engage in regular physical exercise. All right. Healthy diet, sleep well, not because you're a trader, you must be burning night all the time. All right, so regulate stress hormones and maintain cognitive function, very important. Stress management, develop techniques, mindfulness, meditation, deep breathing, take regular breaks during trading. When you're done on this next trade, please just stroll and go do something else. Thank God it's Friday. Go enjoy yourself. Do something else. Reset my mental state and prevent emotional escalation. You just have to. So building confidence, education is key. Deep understanding of market and strategy, experience, structured process from backtesting and live trading, gradual scaling of position sizing. You just know when you need to progress. Balanced lifestyle. Avoid letting trading consume your entire life. Cultivate hobbies, relations, outside the market. Reduce psychological pressure to succeed. Don't be in a hurry. Everyone you see doing so well, like chairman is speaking 50, 70, 60, 80 pips. While some others are taking 40, 60, 50. Allow those things, let those things grow. Don't want to jump into doing the much chairman. When I tried it, it was not funny. When chairman will post 1,000 a day, 1,000 a day, I'm not up to 10 years yet. I dared it. I'll do 840 something, 940 something, and I'll lose it. I'm like, what? What was I doing? I was actually trying to measure up to see if I can come up to the level of chairman, until I came to self-realization, like, boy, leave that level for now and stay at your lane until you come up to that level. And that has been very helpful. All right. That has been very, very helpful. So I hope you got value. And if you did got value on this, just put value on the chat box. Put value on the chat box. And that's how I come to the end of trading psychology. This material, I spent time to put it together, and I'm happy I've been able to give it to us this morning. So thank you. This is my own contribution to the community. So thank you very much, Chairman, sir. Please take it away, sir. Thank you.
All right. Mr. Zike, well done. While we wait for chairman, I want to celebrate you for stepping in real quick into this trading psychology. As a matter of fact, everybody should sit down. I hope this was recorded. Everybody should sit down, go and listen to it again. Kindly help me celebrate Ezike